Hello and welcome to Avalara Sales Tax Changes. I'm Zach from the Earmark team. And just so everyone who's watching live knows, you can earn CPE for this webinar by using the Earmark mobile app. Just download the app by scanning the QR code you see on your screen or search for Earmark on the App Store or Google Play Store. But unlike traditional webinars, Earmark does not use polling questions during the presentation. Instead, you will verify your learning by taking a short quiz after this is over. Once the quiz is available, we will notify you via email. You can then use the app to earn your CPE certificate. So again, don't worry about polling questions or attendance checks today. Just enjoy the webinar and look out for an email in a few days with a link to earn your CPE. And now let me introduce you to your instructor for today, Scott Peterson. Scott, take it away.
Thank you, Zach. Welcome, everybody. Appreciate you all taking some time to join us today and with our friends at Earmark to talk about the 2024 tax changes that we think are going to happen. And we're going to talk about a variety of things today. And if you have any questions, please send them on. And thanks for listening. So this is our disclaimer. Hope you find this helpful, but we're not giving you legal or tax advice today. So if I pique your interest in something, we're happy to help you find someone who's licensed where you are to help you understand what the particular things are for where you're at and what you're trying to accomplish. That's me. I talk for a living, honestly, but I do tax policy and government relations for Avalara. I've been doing it for a long time, and we're happy to be involved in making the accounting industry as good as it's possible to be, and we have great relationships with the accounting industry. So today we're going to talk about digitalization of international tax, a little bit about digitalization of U.S. tax, do a little income tax updates, but from a very interesting perspective, because we're not an income tax company. We don't do anything with income tax, but there's things about income tax changes that folks in the sales tax business need to understand. We're going to talk about economic nexus and marketplace facilitator laws, 1099 updates. What is the 1099 update? Retail delivery fees, something that's very complicated and maybe something that's going to become very prevalent. We don't know. Some state-specific things, some software conversation, and then taxes on streaming. And then if you have questions, we're happy to take them. So taxation goes digital. And, tax has been going digital for a long time, but mostly because you all are going digital. The world is becoming electronic and digital, and it is just natural that tax would follow. And governments are often beneficiaries of what the private sector is doing in going digital, because governments then take advantage of what the private sector has already done, and it becomes honestly less of a burden when you do it that way. When the government's lagging, it's actually helpful because in their minds anyway, because you and I don't see it as some sort of burden that the government's placing on us. Well, the worst case is, they finally caught up with us, so we're gonna now give to them what we've been giving our competitors and our suppliers and our whole supply chain, for years. So going digital it's a good thing that they're slow. It's a little bit different around the rest of the world. The governments are kind of leading the charge around the world when it comes to digital taxation, and not so much digital taxation, but digital record keeping. You've all heard about e-invoicing, and e-invoice is this concept where the government defines the parameters of an invoice and then expects everybody to adapt their invoicing to the parameters that the government has described. And then that becomes a mandate. And what they're trying to accomplish is the rest of the world has a value-added tax. United States is one of the few places in the world where there's, technically a sales tax, and one of the few places in the world where the federal government doesn't have a tax on transactions. The vast majority of the federal governments around the world, that tax on transaction is a major component of their tax structure. Well, the U.S. doesn't have that. They have little tiny ones, little excise taxes here and there, but nothing like what you would see with a value-added tax in any place around the world. The value-added tax has a peculiarity in it, because you pay the tax every time in the chain of supply, that there's always tax on every invoice. So every wholesale invoice has a tax on it. Every retail invoice has a tax on it. Every manufacturing invoice has a tax on it. Every time, imagine you're buying a car, and there's value-added tax on the price of that car that you're buying, but every component that went into making that car was sold to the car manufacturer, and they paid value-added tax to the supplier of that part, going all the way back to the day when the iron was dug out of the ground, and then is sold to a smelter. Well, that iron ore company, when they dug that ore out of the ground and they sold it to a smelter, they charged them the value-added tax on that iron ore. And then every time that piece of metal gets sold and resold and resold until it gets turned into a part that goes onto your car that you buy, there's value-added tax charged in every one of those situations. And they get a credit whenever you charge the tax. When you sell it, you get a credit for the tax that you were charged. So the tax is designed to be on the value that you added. That's why they call you a value-added tax. And so, but there is this way to submit fake invoices in this process and get a credit for a tax that was actually never paid, because there was never an actual transaction. And so the solution is to force businesses to provide invoices either at the time of sale, frankly, immediately prior to the time of sale, or immediately after the time of sale, so that there is this, every time there's a transaction, there's a chain of custody that the government is keeping track of at the same time. And so every time that piece of iron gets turned into something else and is sold to somebody else, and the tax is collected, that invoice is going to have to be submitted to the government. So the government always knows, wait a minute, I got this invoice, and I've never seen this kind of invoice before. I've never seen these two companies before. I'll understand why they're submitting a request for a credit on the value-added tax when we can't find there's an invoice before this one or an invoice after this one. That's the point. They're slowly working into the mandate side of this thing. So the mandate is twofold. One, you have to start using the particular e-invoicing standard, and they're kind of standard. There's some differences between the countries. And then they're going to force you to be providing these invoices to them in electronic format in whatever order that they want it in, whether it's pre-sale, at sale, or post-sale. And we're starting. This is rolling out, and it continues to roll out. And we see some fits and starts in some countries. France just announced they're going to delay it a little bit longer, and they're going to phase it in. And it's a hard thing to phase in, because everybody, one of the concepts is to phase it in by size of business. Well, even the world's smallest business occasionally sells to the world's largest business, and the world's largest business is going to have to do this first. And so everybody that they buy from or sell to is going to have the same thing. So it's hard to do this. But they're working on it. We aren't in that phase because we're just not that. The sales tax isn't as prone to fraud as value-added tax is. And because we don't have a national sales tax, there isn't some overarching government that can enforce this change throughout the United States. Okay. What we do have is being driven by the Federal Reserve. The Federal Reserve has started two things. One is called FedNow, and FedNow is an initiative designed to reduce the cost of moving money from point A to point B and to speed up how long that takes to happen. You know, we're very slowly transitioning out of a currency-based economy, you know, and a check-based economy, and we're all moving toward, you know, electronic transfers of money. And it's, you know, in checks were very slow. Cash is very quick, but cash is still an issue because you get, in many cases, the cash has to go into a bank before it has any value to a business. And that takes time as well. And credit cards, you know, there's a delay in when that money gets back to the retailer. So you make a purchase, you make a sale to someone today, and they use a credit card. You don't get that money instantly. It comes later, and there's a fee associated with it. And so what the Federal Reserve is trying to do with FedNow is to reduce that period of time, and then to reduce the amount of money that gets charged whenever money is moved back and forth. In the government space, this is a big deal because the governments collect billions and billions and billions of dollars. So there's billions and billions of dollars that are being transmitted to the governments around the United States almost every day. It's certainly, for sales tax purposes, it's not every day. It's, you know, for the most part, it's once a month. But for withholding taxes, you know, that could be an everyday thing because every employer pays on a different schedule. And so it's very likely that, you know, states that have personal income taxes are getting withholding payments from payroll companies every day because their clients, some days they pay on Tuesday. I mean, some pay on Tuesdays, some pay on Wednesdays, you know, and some pay weekly, some pay monthly. And so there's just a never ending stream of money that's being delivered to the government. So, and there's a cost to sending and a cost to receiving money. And so the FedNow project is intended to reduce that issue. Where it eventually could impact sales tax businesses is if they get to a spot where it's very cheap and it's very fast, governments will start to wonder why they can't get their money faster. Now, with payroll withholding, I mean, you get paid every week, you get paid every 2 weeks. You can't speed up that process. So I get paid every 2 weeks. The absolute soonest that my employer could give that money to the government is the day I get paid. I haven't actually earned anything. There was no transaction until that day. Sales tax is different. I mean, sales tax transactions are going on all the time. There is tax being collected by a retailer millions of times a day. And that if we get to a spot where you can move money at the time of the transaction and it costs practically nothing to do so, we will see governments want to see their money quicker than they get it today, which today, for the most part, they only get monthly. And in some states like California and Illinois, they only get it quarterly. The Digital Business Networks Alliance is the e-invoicing side of this. It's an e-invoicing project that's looks like the e-invoicing project that you see going on around the rest of the world. It's a voluntary concept today. It isn't. There's no government mandate associated with this. It is a kind of a government business partnership designed to reduce the cost of doing business by getting invoices in a format where they're machine readable, machine actionable, not just machine readable, but machine actionable, where there is just this automatic computer to computer not manipulation, but anyway, sorry. And so computer A can see the invoice, process it just as comes from computer B, just like you would if you had a person doing it. And the point of this isn't to force any businesses around the United States or doing business in the United States to adapt to a particular format. It's to give people the opportunity to see the value in a format driven reduction in cost due to the ease and simplicity of automating the transaction via automating the format of the invoice. So if income tax, like I said, we're not an income tax company. We don't do anything in this space. But there's a couple of things I wanted to talk about because I think it has some relevance to people who are in the sales tax business. As you all know, the world of sales tax changed radically back in 2018 when the Supreme Court issued its decision in South Dakota v. Wayfair. And we went from a world where a state's authority to require a business to collect their sales tax was solely a function of whether or not that business had a physical presence inside that state. No physical presence, no authority. Lots of reasons. Supreme Court didn't like that. Haven't liked it for a long time. They've just never really had the right case and the right membership on the Supreme Court to overturn a decision that they made in 1967 that they have long sought to change because of the odd outcomes that come with having physical presence be the standard for sales tax compliance. And if you read that case, they talk about how the least sophisticated business in the planet can have to collect sales tax everywhere, and the most sophisticated business on the planet doesn't have to collect sales tax anywhere, simply based upon how they're conducting business. And a long time ago, when I used to be the executive director of the Streamline Sales Tax, this lady called me, and she was in a panic because she had received a lien from the state of Kansas, and she had no idea what it was about. And her husband repaired wells. I mean, he's just this remarkable talent who is, world famous for being able to repair water wells and all wells, frankly. But only way he could do his business was inside that state. There was no way for him to do what he did outside the state. He couldn't do it remotely. There was no internet that was going to help him repair that well. So every time he got a contract, and he would go to a new state. Once you get in that new state, you got physical presence. And at that point in time, if they tax what you do, you have to figure out how to do it. And this was a two-person business, her and her husband. She ran the business, he did the work. And she had no idea how to deal with all of the requirements that might come every time he opened, he effectively started a business in a state. And it might be a one-time business. Whereas, you have the world's largest online retailer who, for a very long time, collected sales tax in very few places, but made sales everywhere. And so the court didn't like that. That's why they got rid of the physical presence rule. What they created in its place is what we call economic nexus today. Because businesses now have a presence, have nexus, in any state where they have their sales exceed a certain dollar threshold, they're starting to encounter states that have a corporate income tax based on economic nexus. For a long time, we used to have this three-factor apportionment formula, and all the accountants understand three-factor apportionment formula, where it was always a function of your payroll, property, and sales. And now it used to be universal. Every state had that had a corporate income tax. Very few have that now. They're all moving towards sales, or heavy doubly weighted sales, or triply weighted sales, or just sales alone. Well, the states that are moving towards sales are also moving toward a sales-based economic nexus standard. And so we're starting to see states that are changing the nexus requirement for their corporate income tax to mirror the nexus requirement for their sales tax. So Washington B&O tax. It's not an income tax, but that's what they have in place of their what they have that they view as in lieu of an income tax. The Ohio CAT tax. These are taxes that are based upon the sales that you make in a state, And so they're adapting to the same economic nexus threshold they have for sales tax. So the only reason why we're talking about income taxes is to make sure that everybody has that in the back of their mind when they're thinking about what they're doing or what their clients are doing in other states. Once you submit that sales tax license application, it triggers other actions inside of a Department of Revenue, and that might very well lead to a corporate income tax nexus questionnaire, or or a personal property tax nexus questionnaire. There's other taxes that people have to have in the back of their mind, other than just sales tax. And a lot of this comes from the Wayfair decision from 5 years ago. So we did a little survey. A survey. We were trying to figure out, okay, what's the world look like? Where's our knowledge base for people 5 years after the Wayfair decision? And so in our survey, 72% of respondents think online sales tax laws are complex and confusing. Well, the fact that it's only 72% kind of surprises me. It should be 100%. So clearly there's some folks out there that are doing business in very few states, or that we surveyed anyway, because you get past 3 states, it gets pretty complex and confusing almost instantly. 40% of respondents say economic nexus laws have increased the cost of managing tax requirements. It should almost be a duh. The fact that it's only 40 surprises me as well, because there's no question, if you are required to go from one to many, the cost of compliance is going to go up correspondingly. Every state has a sales tax return. Every state has a sales tax payment requirement. There's a body of knowledge you have to understand to be able to accurately collect the tax, how to deal with the exempt sales that you make. All that none of that comes for free. And all of that is a cost that somebody has to bear, and the state isn't bearing it in most cases. And then 72% of respondents says they've invested in technology to help. Well, that's what we do at Avalara, and that is one of the areas where the states are, helping to pay the bill for the cost of compliance. But I honestly, I've been doing this for a long time, and it's hard for me to imagine anybody not doing this in a way that's automated in some manner or another. There's just too many variables out there to keep in mind. There's 13,000 local governments with a sales tax, and while some of them are relatively straightforward, some of them aren't. There's 2,300 sales tax jurisdictions in Missouri. There's 1,750 in Texas, and their tax base is the same in both for the most part. So if if what you're selling is subject to the state sales tax, you got a pretty good idea that what you're selling is subject to the local sales tax. But the rate that's involved in that it can be quite different, and it can vary very, very quickly based upon crossing the side of a street. In Missouri particularly, you cross the street, the tax rate changes in lots of places in Missouri. So what's new? So all 45 states, the District of Columbia, Puerto Rico, that have a sales tax have economic nexus now. In addition, we have Alaska. Alaska doesn't have sales tax, but the cities and counties in Alaska, I think they're up to like 110 of them now, have a sales tax, and they're very different from each other. There's no requirement that they tax and exempt the same things. They all have different holidays. The tax rate changes by the time of year. When it's tourist season, tax rate goes up. And it's very complicated to do business in Alaska from a sales tax perspective. And we have to include them in there because they believe they have the authority to do it. We're seeing some changes in the definition of economic nexus, not in the actual definition itself, but more of a focus. When South Dakota's law had a requirement that someone would have to get a license and collect their sales tax if they had $100,000 in sales or 200 separate transactions. Well, over the last 5 years, states have realized that 200 separate transaction thing created anomalies. In many ways, it created the same kind of anomalies that we saw with physical presence. You had very small retailers having an obligation to collect sales tax, that they might be competing with other retailers, but the cost of compliance in many cases exceeded the tax they collected. And that is where that concept is finally starting to catch inside the heads of state policymakers, and they're starting to step back and think about the burden that they're imposing. And as you might imagine, it's, if you sell something that costs $1, it's pretty easy to, and it's a popular thing. It's pretty easy to get you 200 sales in any state. And you'd had $200 in sales, and the average sales tax of 6.5%, you've collected $13. And, the cost of compliance for and maybe they'll let you file that sales tax return once a year, but still, it costs $40 to $50 to file a sales tax return. And, the thought of spending $50 to file a return that you remit $13 on is kind of offensive. So we're starting to see states drop that. We had 2 states that dropped it last year. We expect to see more in the next couple of years. State legislatures don't meet all year round, so getting the law changed in any state isn't something that can be done just overnight, because they have to be in session. And for the most of them, today is the 27th. For the most of them, that starts next week. Yeah, I think in most states it's the first Tuesday after the first Monday in January. So real soon we're going to start seeing lots of state legislation, and we will certainly see some more states get rid of that 200 transaction. And you look at this map. Here's the map, the current map of economic nexus by state. The blue states are the ones that still have the 200 transactions, and if you look at them, they are mostly streamlined sales tax states, which is what South Dakota is. And that's, in the Supreme Court's decision in Wayfarer, they talked a lot about the streamlined sales tax, and the things that the advantage that comes to retailers from a state being a member of the streamlined sales tax. Well, because South Dakota was a member of the streamlined sales tax and the Supreme Court talked about that, every state adopted exactly the same law South Dakota had. So if you look at this, and most of the states that are in blue are members of the streamlined sales tax. So they've got an initiative going on where they're going to try to convince their members to get rid of the 200 transactions. But you see, we still have, even if that were the case, we'd have less complexity than we have today, but we'd still have some. California and Texas and New York, they have $500,000 in sales. At Mississippi and Alabama, it's $250,000 in sales. And honestly, none of us can figure out why it's $250,000. But in theory, in a couple of years, we should maybe just have 3 colors on this map instead of the 1, 2, 3, 4 that we have today. And that will make things simpler. The challenge is something that most of us I didn't even imagine that this would turn out the way it's turned out, but it is. So look at this map. You got 4 colors, and except the gray states that don't have a sales tax, except for Alaska, which we color in blue because the cities and counties are enforcing economic nexus. You go to this state. This is the map that talks about the difference between the differences resulting from the definition of sales. South Dakota is a gross receipts tax state. Their sales tax is imposed upon the gross receipts a retailer receives for making sales. North Dakota, it's not. North Dakota is a taxable sales state. Indiana is a gross income state. Arizona, New Mexico, Hawaii are gross receipts states, and they're really more kind of a gross receipts tax. And they're not just gross receipts states, they're kind of gross receipts tax. And so when you think about it, even if all these states had $100,000 in sales as their threshold, the difference between gross sales and taxable sales and gross sales and retail sales is huge. You could very easily, and so, for example, and I use South Dakota and North Dakota as an example because I'm originally from South Dakota and I spent a long time trying to understand the differences between the two. Their sales tax was adopted exactly the same year. And they were almost virtually identical. Obviously, the same person wrote the sales tax law in South Dakota and North Dakota, and both states adopted it in the early 1930s. And then it just continued to change. That was the one and only time in the history of their sales tax where their sales taxes were alike. And they've changed significantly ever since. And South Dakota taxes everything. Literally everything. They tax accountants. So if you're a CPA or an accountant and you have South Dakota clients, you're very likely a taxpayer there. And if you're billing your clients more than $100,000, you should be calling the Department of Revenue and asking them if that has created an obligation for you to get a sales tax license and charge your clients a sales tax on your accounting services. Same with lawyers, engineers, architects. They tax everything except healthcare. And North Dakota is different. North Dakota taxes tangible personal property, and that's it. They don't hardly tax any services. They tax almost nothing that's digitally delivered. So if you sell shoes in North Dakota, you're going to collect sales tax. If you sell shoes, you're going to collect sales tax in North Dakota and South Dakota. If you're an accountant, you're going to collect sales tax only in South Dakota. So imagine one is gross sales, the other is taxable sales, which means resales for resale. So even if 90% of the sales that you make in both states are sales for resale, if you go over $100,000 in South Dakota, you're going to have a license and collect sales tax on that 10% that aren't retail or sales for resale, which are taxable sales. In North Dakota, you wouldn't. You wouldn't have to have a license to collect sales tax on any sales unless you got to more than $100,000 in taxable sales. So you're trying to advise clients on how to manage their just definition of nexus. This kind of map you have to have in the back of your mind. You have to count sales by state. Then you have to know the difference between retail sales, taxable sales, and gross sales, because each of those differs, and each of them create each of these states has a different trigger for economic nexus. So when the Supreme Court adopted its law, or its law, no, they didn't. When they issued their opinion in South Dakota versus Wayfair, states took that as an opportunity to go after something they've been trying to go after for a very long time, which is marketplaces. For a long time, states have been trying to get marketplaces to collect sales tax. And because, in many of those situations, there were marketplaces that were selling things where there was somebody selling in a marketplace in a lot of states that would otherwise have to collect sales tax if they weren't selling through the marketplace, but the marketplace itself didn't have any nexus. And so it drove states crazy. And they had lots of different ways over the years where they tried to redefine nexus to get at these marketplaces. And of course, all that went away when the Supreme Court's decision in Wayfair came out. So what they've done is they've adopted a definition of a marketplace, and they've imposed an obligation to collect sales tax on the marketplace, just as if the marketplace were a seller, as if the marketplace was the seller. And, for some marketplaces, this was nobody ever thought it was fine, but it fit their business model better than others. There were a lot of marketplaces, the states very quickly came to realize, that didn't collect sales tax because they didn't sell anything. All they did was facilitate the sale of somebody else's product. None of the goods sold in the marketplace were theirs. So they never collected tax because they weren't their sales. And the way these laws are structured, that's irrelevant. There's two ways the states do it. The one way is to simply say the marketplace is a seller. The law literally says we hereby deem you to be a seller, and you shall have all the rights and obligations that come with being a seller in our state. And there's very few rights, but there's a lot of obligations. The other way is that they pass a law that imposes a sales tax collection on all sales made through a marketplace with the obligation of the marketplace to collect the tax. So they facilitate, not only is the marketplace facilitating the tax, facilitating the sale in that state, it's also facilitating the tax collection in the state. So they kind of kept the intellectual purity that goes along with being a marketplace, and all I'm doing is facilitating. And the state just added sales tax collection to the list of things that come under the definition of facilitating. Either way, the state imposes an obligation and expects the marketplace facilitators to remit all the sales tax that should be collected from all these sales. Every state has one of these things now. Our concern today is that there's a couple different definitions of marketplaces. There's a very broad definition like you see in California, and then there's some narrower definitions. And we're concerned that we're going to have a world where, I haven't seen it yet, but I assume we will, where state A says you are a marketplace and state B says you're not. And for the marketplace, that's just fine. They probably, for them, they don't care. For a marketplace sellers, that's a problem. Because marketplace sellers, people who sell via marketplaces, assume after all these years that the marketplace is legally required to collect the sales tax. And if that marketplace goes and gets an opinion from the Department of Revenue that they're not a marketplace, that means they don't have an obligation to collect sales tax. And then the obligation to collect sales tax immediately follows to all the people who sell on the marketplace. So at that moment in time, that marketplace seller has to start keeping track of those sales differently than they would of sales made through that same marketplace in any other state. Now, like I said, we haven't seen this yet, but I'm convinced it will happen someday. And at that moment in time, seller's life becomes much more complicated because they then will have to go back to keeping track of the number of sales they make in the state to know whether or not they've exceeded the economic nexus threshold in the state. And it'll just become just a big mess. And it might be a mess that comes without any warning, and maybe with very little notice, and practically with no grace time built into getting the compliance done. Okay, so 1099s. We've been listening to Congress talk about 1099K reporting for a long time now. And they passed legislation that reduced the threshold from $20,000 down to $600. And there's always been two thresholds. I mean, and this is kind of part of the frustrating thing. There's always been two thresholds. There's always been a group of people where the threshold was $600, and then there's another group of people where the threshold is $20,000. And so I suppose there's always been an inherent conflict that existed. So when Congress adopted that, though, they clearly today they didn't build enough lead time into the concept, but they did it because they knew having everybody report more 1099s was going to result in more income tax being collected, because the IRS and the state Department of Revenue would have better data, and I wouldn't say everybody, but the folks that wrote that legislation have the belief that there's income that's not being reported, and as such, this income tax is not being remitted.
Hey, Scott, you seem to have muted yourself. Can you make sure you're unmuted?
Thank you, Zach. I don't know how that does that. Appreciate
No problem. Yeah.
So in 2022, the IRS said, well, we're not ready. We can't do it. So they and I don't know how they did this. I read that statute, the law that changes this, and there's nothing in there that I could read that gives them the authority to say, no, we're not going to do it. but they did it again. They said, okay, we're going to start this on January 1, 2024. And then a month ago, they said, no, we're still not ready. We're going to start this on January 1, 2025. And we're going to have a $5,000 threshold instead of the $600. And of course, that's not the statute either, which is why you're starting to see members of Congress ask, show me the law that says you have the authority to do what you just said you were going to do. We'll see where this goes. I think it's very likely that it will be less than 20,000, probably not 600. And it's certainly not going to be before January of 2025. This is a challenge that surprised everyone, and I think especially surprised the people who wrote this law. So this 2022, in 2021, the Colorado legislature decided they needed to expand the sources of revenue for transportation funding purposes. And they looked around, and just as way of background, for a long time now, states have been very concerned about their ability to build and maintain highways, because the primary source of funding for that is the tax on diesel fuel and gasoline. And that's been the source of funding for 3 generations. As vehicles have become more fuel efficient, and some have become gasoline and diesel agnostic, you can put it in if you want to, or you don't have to, or they've been full-blown electric, the amount of gasoline that gets purchased has steadily declined as a proportion of the number of vehicles on the road or the number of miles being driven. Well, the gas tax as a way of funding highways worked really well if there's a direct correlation between the number of miles driven and the amount of gasoline consumed. And that doesn't, it has changed. It's declining. It's going in the opposite direction. And so as a source of funding for highways, it's become very unreliable and doesn't meet the needs today. And which is why you're starting to see states that impose a higher licensing fee on electric vehicles than you do on a gas-powered vehicle. What Colorado did was to look at how their highways were being used and said, so there's fewer people driving, but there are more vehicles on the road. What's the deal? Well, it turns out it's delivery vans. And so they crafted legislation intended to tax consumers who had things delivered to them. And, during the pandemic, this was a thing. Everybody it was all delivered, and I'm still delivered. I mean, something gets delivered to our house every day. And it's a fact that when something gets delivered to my house, I've used the highway system. I could have gotten my car and driven to the store and bought the same thing and driven back. I didn't. I paid somebody else to do the driving. They use the highway system. I'm the beneficiary of their use of the highway system. So philosophically, there's some sense to this. Practically, these are hard to do. So what they did is they imposed a fee. When they adopted it, it was 27 cents on every invoice for products delivered into or in Colorado where there was at least one product on the invoice that was subject to state sales tax. So, and it's a one-time fee, one time per invoice. So it was 27 cents per invoice, assuming there's something on the invoice that's subject to state sales tax. So there's a number of things that make this complicated. First of all, Colorado is one of those states where the local government tax structure is very different than the state. The state tax is local governments tax many more things than the state taxes, but this is going to be a state fee. So for it to be a state fee, it had to be under the state's control, and the state controls what it taxes. So they said, well, we can't have the fee apply when it's something subject to a local sales tax. It has to be state. Okay, fine. Immediately, you have to know the difference between state taxable and local taxable. And you could have an invoice that's everything on it is subject to local sales tax, but not subject to state sales tax, no invoice, no fee goes on that. And then you had to collect it from your customers. You had to show it on the invoice. You had to collect it from your customers, and you had to have a separate license, and you had to remit it on a separate return. We went through probably, I think 8 months. So I started on July 1, 2022. By May of 2023, they changed it a lot. They put an economic nexus threshold of $500,000, which is different than their sales tax economic nexus threshold, which just confused the heck out of everybody. You still have a separate return. You don't have to put it on your invoice anymore. The fee went up to 28 cents on July 1, 2023. And it's overall, it's just a mess. Some of this is because this is an example of an impossibility that exists in the tax structure of the world. It's virtually impossible for a state to collect its own tax. There's very few taxes that the state can collect on its own. And so they rely on a third party to do it. And the third party is a business. And when it comes to sales tax, the third party is retailers. When it comes to property taxes, often the third party is the mortgage holder. And so there's all in personal income taxes, it's a payroll company. It's the employer that is the tax collector for all of the income tax that gets collected on individuals' wages, because there's an obligation imposed upon the employer to withhold that tax from their wages and to remit that to the appropriate government. Well, so this is an example where they thought they'd created a very simple tax: add 27 cents to every invoice where there's something subject to state sales tax. I mean, when you hear that, you think, oh yeah, that makes perfect sense. That's very simple. The reality is no one owns their invoicing system. Every retailer doing business in Colorado, none of them own that retail system. Or that invoicing system. Somebody else owns that. It's a third party. You have to get that third party to fix this. Third party has to change it, give you the authority to add something. It's been a mess. Well, a little bit less of a mess today because of the changes they made. And then comes Minnesota. So Minnesota sees what Colorado's done. They look to see some of the mistakes Colorado's made, try not to make the same mistakes, and then make their own mistakes. So their fee is 50 cents. Has to have a retail order, has to total $100. But what makes it really complicated in Minnesota is there's some things that are subject to state sales tax in Minnesota that you don't include when you're calculating whether or not you charge a 50-cent retail delivery fee, like diapers. And Minnesota is one of those states that doesn't tax clothing. And yet, because clothing is a huge part of what gets delivered, they wanted sales of clothing that's delivered in Minnesota to have the fee imposed on it. So we have a situation today where there are a lot of retailers around the world that sell clothing into Minnesota that don't have a sales tax license because it's not required, because they're not technically not a retailer, because they're not making a retail sale. They're making a sale of something that's exempt by statute. The way this law is written today, all those people are going to have to start collecting this 50-cent fee every time they ship a article of clothing inside of Minnesota. The Minnesota Department of Revenue had a hearing on this last week. I was on vacation. I didn't get a chance to sit in on it. But they're trying to get feedback from people on, okay, how hard is this going to be? Lots of this is supposed to go into effect in July 1 of next year. Lots of decisions that aren't yet finalized, and a pretty good chance that the legislature is going to come in and change it. They might even repeal it. Who knows? But this one, you take the Colorado fee and then make it worse. So, but this is the kind of thing that could easily, if they could work the bugs out of this, and I'm not sure they can, but if they could, this could spread across the country, because there are every state in the country is looking for a different way of funding their highways. So some more notable stuff. If you or your clients do business in Illinois and they're a remote seller, their life is more complicated than businesses inside of Illinois. If you're a business located inside of Illinois and you ship goods around Illinois, you charge the sales tax, or well, they don't even call it a sales tax, retail occupation and service tax or something like that. You pay the tax based upon the point from which the product is delivered. Or we call that origin sourcing. If you're an out-of-state retailer, you collect the tax based upon where the good is delivered. That's called destination sourcing. Well, a company is taking the state to court, arguing that the burden imposed upon out-of-state retailers is immensely greater than the burden imposed on in-state retailers and is unconstitutional. We've been waiting for this case. A lot of lawyers think that this is unconstitutional. We'll see. The state has to figure out what they're going to do. Virginia, they've done, there's every state in the country now but 2 allow out-of-state wineries to ship wine directly to consumers. And Virginia is one of them. And they just recently decided that helping people do that is the practice of law. So folks like Avalara and others, accountants who are helping their clients get licensed in Virginia with the Alcoholic Beverage Commission, can't do it anymore because it has to be done by a law firm. Bottle fees, I keep thinking bottle fees are going to go away, and yet they don't. And now with economic nexus, and you have people shipping goods into states that they never shipped into before. No, let me say it differently. You have people shipping goods into states for which they never had an obligation to collect any kind of a tax before, are now shipping those goods in bottles into states where they have to have a sales tax license. And the states are saying, whoa, wait a minute. You're selling something that's inside of a bottle that we have a bottle deposit fee on. And because you have a sales tax license, you need to be collecting that bottle fee as well. So don't be surprised if your clients start to see more and more of that kind of thing as well. Software. 23 years now. The streamlined sales tax has been up and running. And one of the very first things that the business community asked the states to define in that was software and digital goods. Define it. Tell us what it is. Tell us whether or not you tax it. And 23 years later, the states are still trying to figure this out. And now they're starting to get to the stage, well, we defined it 15 years ago. Is that definition still valid? States are slowly moving toward taxing digital goods and software delivered electronically or accessed remotely, if they tax that same good when it was in a tangible format. One could argue that you should, if you're a state, if you're going to tax it when it's in a tangible format, you should tax it when it's a non-tangible format. Or if you don't want to, then exempt the stuff that's in tangible format. In addition, we still have this Maryland digital advertising tax that's going around. They've adopted this several years ago. It's been in court ever since. The state has won all the court cases so far, but most of them they win on procedural issues and not actually they haven't actually got to the merits of the case yet, because they're still winning on procedural issues. And this is still going. I just read the other day that whereas the Maryland court system had allowed a case to continue on challenging the tax on constitutional basis, and there's some legitimate reasons why the court should look at this and answer the question: is it constitutional to do what they want to do the way they want to do it? Because this is another one of those cases where they're taxing the digital advertising. They don't tax non-digital advertising. So it's on its surface, it looks a little suspect. Streaming services is a whole different thing. It's a lot of states tax cable TV. A lot of them don't tax the streaming services that go over the top, the facilitated by the cable companies. We're starting to see more and more states do that. And we're starting to see this be litigated in a lot of places in local governments, where most local governments have what they call a franchise fee. And it's a fee for the right to use the right of way inside of a local government. So if you're going to string your cable for your service along the right of way of a highway, well, the states and local governments think they should have a right to be compensated for that, and or share in the income in that. And local governments are suing some of these over-the-top streaming services for the right-of-way fee, and they're mostly losing because the statutes that allow local governments to have franchise fees really apply to the people, or at least on the surface, apply to the people who actually own the cable. So the people who install the cable, they have to pay the franchise fee, but the ones that are using that to do what they normally do, some of those people aren't, at least in the minds of the court system, aren't the actual franchisee. So that's it. Zach, thank you all for joining us today. And thank you, Zach, and folks from Earmark for allowing us to present today. And we hope we've provided some information that helps you think about what it is for your clients. And if we can be any of your further help, please let us know.
Great. Yeah, thank you so much, Scott. And just a reminder for all of our live attendees that you can earn CPE for this webinar. We will be sending you an email in the next few days with the link to a short quiz so you can earn your CPE certificate. And again, thanks everyone for attending.